Hey guys, welcome back to another video. Today we're going to be talking about the career options available for commercial bankers that have gone into the career and after several years are looking for the next steps. So this video is geared towards existing commercial bankers and also new commercial bankers that are already thinking about their next steps in their careers. I personally found that there was not a lot of available information out there in terms of talking about the various exit options because there are quite a few. And ultimately, commercial banking is an excellent place to start your career. So what does commercial banking offer you, first of all? Well, working in commercial banking is an excellent entry-level role, allowing students to quickly develop a broad range of skills that they can carry forward into other finance roles. There's a lot of transferable skills. And typically, the entry-level role is a relationship manager, an RM. And what an RM does is they're going to originate, structure, underwrite, and negotiate new loans for the bank. And most RMs actually have an individual annual sales target that they have to hit. And what surprised me, I remember when I first started working as an RM, was the amount of responsibility that was given to me fairly early on, where I could put out a term sheet, underwrite that deal, and submit it to risk with very little oversight from managers, because my managers were also under the guys and, we're working towards targeting their sales budgets. So, once you're on the desk and you're working to deploy loans, you have a lot of responsibility in terms of sourcing and analyzing, and you can do a lot with that. In addition, you're going to be managing an existing book of loans, providing day-to-day support and credit reviews on a quarterly basis to manage that credit risk for those existing clients. This portfolio management is really good because it allows you to develop existing and continual relationships with clients that are already been funded and are already clients of the bank. So you're going to be speaking with them on a monthly or quarterly basis, ask them how their business is doing, listening to their day-to-day pains, learning a lot about the day-to-day struggles of a business owner and their needs, which is really valuable because case studies are one thing, but hearing it straight from the entrepreneur is another. And you're going to pick up on certain needs and wants that are very common across any business owner. And then lastly, you're paid to network. You're paid to get out there and develop a pipeline of prospects and centers of influence, which could be accountants, lawyers, different business advisors and coaches. And these COIs will typically refer high net worth clients to you and business owners that are going to be looking for loans. So not only are you underwriting and analyzing loans, but you're also developing a network of COIs and business professionals that can be transferred to other careers. But at its core, and I love to say this, like in Canada, and I worked in the Canadian commercial banking industry, the average comp for a first-year RM is actually pretty decent. It's between $70,000 to $90,000. An investment banking analyst may be making $120,000 to $150,000 in Canada, but for someone that's looking for a more manageable day-to-day lifestyle and also still wants to achieve some really strong sales skills, this is a great entry-level role. So what do you learn? Well, commercial banking, it offers a very quick path to the front office for junior professionals, and it provides a chance for you to run your own deal, for you to meet clients and learn on the job how to really communicate, sell, underwrite, analyze. And this differs a lot from, an investment banking or corporate banking role where you're much more deal analysis, whereas in an RM in the lower mid-market or the mid-market space, or even in small business banking, you're typically thrown in on the front office with very little support and no real analysts around you. You're the person that's originating the deal and you're the person underwriting the deal. So you're actually wearing multiple hats. And so what that gives you is that, sales and communication is number one, and it is going to be the most valuable skill that you're going to develop in commercial banking. You're going to build confidence. You're going to build the ability to communicate value through that term sheet and how you sell to clients. And as well, part of this is listening to the business owner's pains and delivering a solution that allows them to address those pains. So you're going to be on the front lines. So airtime with business owners is the best return for your time in commercial banking, and it's going to give you a ton of skill set. As well, as I said before, you're going to need a source business to hit those annual targets. So you need to develop a network of professionals to serve your clients, existing clients' accounting, legal, and business needs, but also those same COIs COIs are going to refer new clients to you. So over time, you're going to develop a COI network that you may not have ever have gotten if you were just an analyst in a larger shop for an investment banking shop where you're just focused on deal running and deal analysis. Here, you're in the front lines, and that client's going to pick up the phone and say, hey, listen, I need to incorporate a new joint venture. Okay, well, here, let me put you in touch with a lawyer that I know or an accountant that I know. And that ability to address business owners' needs, again, is very transferable to a lot of careers. As well, when you're meeting day to day or month to month or quarter on a quarter basis, you need to think on your feet and listen and understand the operational needs and the business concepts behind a business owner's day-to-day business. You're going to listen to what they need. You're going to listen to what they're doing, their strategies. You're going to be probing because you're going to be analyzing that business to determine whether you want to lend to it or not. So you're going to be on the front line again, driving the analysis and the discussion between you and the client. And what that does is sometimes in the early days, you may ask some stupid questions, but over time, you're going to really refine a good set of questions that can get straight to the point and identify what you're looking for. So again, reading and analyzing businesses, you become much quicker because you're the person doing it. You're not waiting for someone else to provide that information to you. And then the last thing is you're going to see a ton of transactions in a wide range of scenarios, whether it's mergers and acquisitions, buying a piece of real estate, a management buyout, or, partial shareholder buy-in, buying just equipment for day-to-day, operational needs, or it could be also just working capital. And I need more working capital to finance a purchase order, to finance some extended AR terms, whatever the case is. So, you're going to see a wide range of transactions because in most instances, commercial bankers are not focused on one set of term loans or loans. They're given a term loan solution that can address multiple needs. And again, that allows you to see a lot of different businesses, which ultimately broadens your perspective of the business world very, very quickly coming out of school. I'd say within the first 2 or 3 years, you're going to have an incredible set of knowledge to quickly analyze companies, speak with confidence to owners, and a network of professionals that allows you to take that to other careers in finance. So all of these skills are transferable. So now let's get into the actual exit opportunities. Well, there are a few that I'm going to talk about here, and these are probably the most common ones. So, risk management and special loans is within the bank, but instead of sourcing and underwriting deals, you're analyzing and approving the deals that an RM is submitting to you. So you can stay within the bank and become a risk manager. You can also go into wealth management or private banking. So instead of addressing their day-to-day business needs, you can address their long-term wealth needs in terms of managing their stock portfolio. You could go into investment banking and M&A advisory. You could also go into the buy side, join a private equity firm or become a corporate development professional to source deal opportunities to acquire. You can go into private debt or private credit, which is the higher end of the risk curve in commercial banking. Typically, banks are going to be very traditional, boilerplate. We have our lending programs, but more creative structures, interest-only, patient deals, is going to require a private lender. That's money's going to be much more expensive, right? And so these are more creative and typically sexier deals that you work on. That could also be something that you go into. Or lastly, you could even join a client. I've seen people join clients or even buy a client in their book or just go off and buy a business altogether because they want to kind of get that experience. They've been listening to their clients talk about their day-to-day businesses, and now they want to go and do the entrepreneurial route as well. So these are kind of some of the common areas to exit into. Each one has different advantages and disadvantages, but I'm going to be kind of focusing in on each one. And I've seen some of my friends and colleagues and mentors transition into all of these roles. So I can give you my perspective on each of the exit options here. So let's first, before we even go into this, talk about staying in commercial banking. What does the long term look like? So what really surprised me a lot of commercial banks is that they're all pretty flat organizations. There's very few layers to management, right? You have your RMs, your relationship managers, and your SRMs, your senior relationship managers that handle the day-to-day business needs, but there's not a lot of, SRM, AVP, blah, 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 all these positions to kind of segment and rank front-facing, client-facing deal makers. The relationship managers are just relationship managers. Either you're a junior RM, a RM, or a senior RM. Over time, you just slowly climb up, and every year your sales budget expands and expands and expands as you get more and more established. Now, there are regional directors that will manage branch networks or office regions or geographies of RMs and SRMs, and then there are VPs that manage directors. And then those VPs will eventually report up to an executive vice president of commercial banking, which is typically one, maybe two people in an entire bank. And they're kind of the head honcho in that division, feeding up into the actual, business banking group of that ultimate company. But as you can see, there's not a lot of layers. Like, for the difference between the head of the group and the relationship manager is 3 positions. At the company that I work for, we had a associate director, senior associate director, director, VP, head of commercial. That was it. And that was one extra layer relative to this table here. But you can see that, realistically, the challenge in flat organizations is that these people don't turn over a lot. They may turn over 5-10 years. So climbing up this ladder is going to take a very long time, and a lot of people are not going to have the ability to move up to a VP role. Most people cap out at a regional director role, and you can see the salary differences. You can earn up to be about $250,000 in Canada in the commercial banking space for the big banks, and in the US typically you add another $20,000 to $50,000 on top of that, because they usually earn more on their salaries. You could probably earn about $300,000 being a regional director in the US at a commercial bank. And then, obviously, once you get into the VP and EVP roles, you're getting paid an executive level salary, which is much more. But, realistically, the ceiling for a lot of people is going to be the regional director role. And one of the challenges is that because it's a flat organization, the regional director and down are client facing. The VP, very little exposure to clients anymore. And the EVP is not doing any deal writing anymore. So if you really love this job for the sake of, I love doing deals, I love meeting clients, I love meeting businesses, then the challenge is you're going to get promoted higher and higher, but your client interaction actually reduces. So a lot of people end up rotating out of divisions. They might go up market or down market. So an example, if I was a lower mid-market commercial banker, I could do loans between 1 to 50 million. And they said, hey, listen, you're a director, you've been director for 5 years. Now we want to promote you higher, and you want to stay on the client facing side. Typically what they'll do is they'll rotate out and step down maybe a level or go flat, that same position, over into the $50 to $250 million group in the mid-market or national accounts division. So that's one of the ways that you can kind of maintain that client-facing role. Or the other one is, just changing out industries. So if you're in a real estate banker, you move into, medical and healthcare professionals division, or you move into the equipment lending division, and you try to get a different industry exposure to really defer the ultimate move of you being bumped up beyond the client level facing roles. So that's why a lot of bankers don't stay longer than, I would say, the average tenure is 7 to 10 years. After that, you've hit the regional director role, you've probably maxed out all the compensation you get, and all that you're doing now is just doing the same thing over and over again to get that same level of compensation. So there is typically a cap out. It's very difficult to exceed that regional director role. So if you don't like client-facing roles and you still want to stay within the bank, the natural first step is to go into risk management. So if being a relationship manager in the grind of finding deals, managing a pipeline, hitting annual sales targets is too challenging for you, typically after 1 or 2 years in a client-facing role, just to get your toes wet in that region of the bank, they will rotate you into the risk management group. And risk management, as I mentioned before, is the people that are approving the deals that relationship managers are submitting into risk management. So there's typically an adjudicator that will sign off on the analysis that an RM is doing and ask for more information, challenge their thinking, and whatever the case is, to make sure that they're protecting the bank's money. Now, because it's non-client facing, it's more of a cost center, and a lot of times risk management, the managers are paid lower. So if you're a regional director, you may be making $250,000 on the client-facing side. You may be making $150 to $200 on the risk management side if you were that same director. So there's a big difference in salary. For most entry-level risk management roles, though, you're anywhere from that $80,000 to $100,000, but with very little bonus. Because what is your bonus? You're really managing loan losses. You're not managing sales targets. So the bonus pool available to risk managers is much less. But it works for some people. So the credit team, really is for if you love deal flow, but you don't want to source deals, and if you love to analyze and get into the details and are much more analytical, credit adjudication and risk management is a very cool place to be. I personally was considering this when I kind of reached the top of my, organization here on the client-facing side, and I said, hey, I'm getting bored. Like, I'm just going to do the same thing over and over again and do more deals. Do I want to look at more sexy deals, challenging deals, and look at a ton of them, or do I want to consider something else? And I personally exited the bank, but some people rotated into this just to get more stimulated from a mental perspective. Now, there's another group within risk management called special loans and restructuring. And this is really the credit solutions team, the special loans team, where a loan underperforms, typically after 2 successive quarterly breaches and covenants. That loan will be referred to the special loans team. And from then on, they will manage that file on a monthly basis, tracking the financial performance, making sure that the business is either turning around, or if not, they're already pre-planning on how to exit that position, whether it's pushing the client into bankruptcy and selling off the assets and liquidating it, or advising the client to find a potential buyer to buy them out and buy them out of the hole, or maybe even just providing advisory services to help them turn around. So special loans is a really cool region of the bank if you were interested in consulting and turnaround situations, because these are the bad credits that have gone sideways, and there are situations that are just you can't turn around, and it's really the case of liquidation analysis. But there are other situations where the client's just on the edge. They're struggling, they're making a few mistakes, there's a few low-hanging fruit, and the special loans team will go in there and use the bank's clout and the bank's ability to use their covenants to force that management team to correct the business in some way. So being a bit of a consultant to underperforming businesses is exciting. And this is another one of the areas that I was thinking about getting into. But ultimately, the challenge with both of these things is that you're moving away from the client-facing side of the bank. And so now you're really entirely dependent on internal progression within the bank, because you're going to be removed from your network. So the years that you spent building your COI network, building that sales pipeline and those client-facing roles are now gone. And if you stay long in risk management, it becomes harder and harder to rebuild those networks. So some people may jump to risk management, spend 1 or 2 years, and then jump back to client facing. But in most instances, people that go into risk management stay in risk management because it's hard to get out of it afterwards. So let's talk about exiting the bank. So one potential scenario is exiting into commercial investment banking. And I did this myself. So I left the commercial banking and I moved into the M&A market. And, your sales and underwriting skills are perfectly positioned for IB. You're looking, for when you're a commercial banker, you're looking at the deal from the debt side. But, that same analysis can be applied from the equity investment side as well. All you're looking at is lower on the cap table. So the analysis, the LBO models, and the structuring from a cash flow analysis perspective are all the same. Investors invest on a net cash flow basis, and so do debt investors. They look at the net adjusted cash flow of the business to determine if they can service the loan using the available cash flow net of any required operational obligations. So, the analysis is the same, and a really natural fit is that you continue to operate in the same market segment. So I was serving lower mid-market businesses below $50 million in value. I'm now selling businesses below $50 million in value, and you can monetize your client book. What that means is that if you've spent a few years in the commercial banks, you have 100 client book, 100 person client book, and you've put on 10, 15 deals a year, you probably have a solid network of 150 established business owners in your region that are high net worth and that may potentially want to buy or sell. So you take those relationships, then you go find a sell side mandate and you try to sell it to those same people. It can be a very profitable thing. For me personally, when I left the bank, my very first sell side engagement was actually a prospect in my pipeline on the commercial banking side. And I left and I quickly went to that prospect and I said, hey, listen, I've left the bank and I'm doing M&A now. Do you want to sign up with me? Yes, I do. Bingo. And that's how I got my first lead. And I monetized my relationships. That's all it is. So don't look at your book as a burden. It can also be of monetary value if you move into, say, for example, investment banking, where those relationships could be potential buyers or sellers for you. And unlike climbing the IB ladder internally, trying to grind out at the analyst and associate levels, if you spend 3 to 5 years in commercial banking, you've rounded out your sales skills, you have a good credit analysis and financial analysis, you can still read financial statements just as good, but you've practiced and have already developed the sales network. So most people that go into commercial banking will exit into investment banking into a client-facing role. You skip the grind of being an analyst and you move directly into client-facing. It's easy. Like I skipped multiple steps in the investment banking world because I just focused all of my efforts in commercial banking on relationship management. And when I moved over, those relationships were worth a ton to investment banking shops because they looked at that and say, hold on a second, you can generate more fees for the firm if you're out there speaking to those same people, targeting that same sector that you're working on. We don't need you analyzing deals. We got a bunch of guys that are coming out of school that are commodities and can do that and build those models. You go find the fees and go generate the revenues because that's the most important thing in investment banking. So that's really important to understand. I think commercial banking actually allows you to skip a few steps if you ultimately wanted to get into investment banking. And, a small division within investment banks, if you look right here at the third paragraph, is that some investment banks even have debt advisory groups. That means that typically businesses that are very large, very busy, don't have a CFO or don't understand the requirements of going through a term sheet process may actually contract an investment bank to be their financing advisor to source term sheets and ultimately source debt for that business. So, you can do the same thing that you were doing on the commercial banking side, but being an intermediary and reaching out to 12 banks instead of just your single bank, and you're an investment banker. Now, there are some downsides to that. Typically, the fees in debt advisory relative to sell-side advisory are much less. You may make 2% on a term loan placement, where versus 5 to 7% on an M&A loan. So obviously, the fees are going to be higher on the sell side, but this is a much more comfortable area for you of being a commercial banker because that's what you've been doing anyways. So it could be an option. Now, what if you exited into wealth management? Well, wealth management's pretty broad. You have the discretionary asset management where you're picking stocks and analyzing, doing almost like an equity research type role. You could be a financial planner where the stock picking is centralized in the bank and another division manages that, and all you're doing is managing the client relationship, giving them day-to-day advice on their financial planning, savings, budgeting, different tax and estate situations. So, it depends on where you want to land. But I would say for the most part, if you're in commercial banking, moving into a relationship management role on the wealth management side is a very easy and profitable transition. The thing with wealth management is that it's a long-term gain. You want to build a book of business because it's a tolling type business. You collect $50 million in assets under management. You charge that book 1% or 1.5% annually. And so it's an annuity, that book of business. So really the goal for you as a commercial banker, if you wanted to get into this, is to pivot those relationships, monetize those relationships, similarly to investment banking on the commercial banking side, and convert them into wealth clients. And if you can convert 5 clients, and that's $10 million, in assets under management, that's worth a ton of money. That's worth tons of money. So you can generate an easy $100,000 in fees, recurring, annually guaranteed, booked, because you've just moved $10 million in assets over from your commercial banking book into your wealth management book. And it's a natural fit, especially if you stay within the bank. So typically banks have a commercial banking or lending group, and then they'll have a wealth management group. You move over as a wealth associate or just a junior wealth advisor, and you go back to your existing client book, and some don't even have accounts on the wealth management side, and you just say, hey, listen, I moved over, we're really good friends, we've known each other for 5 years, I've helped you out a lot, I'd love to, be your wealth advisor now as well. And you're a proven commodity, they know your brand, they know your worth, hopefully it's high value, and bingo, you've signed up your first wealth client. So instead of grinding it out like someone that comes straight out of school and going into wealth management, you are leveraging your pre-existing client relationships to convert them into wealth clients. So that's really good. So what if this is what you wanted to do? I would say the first thing is, if this is your goal, you want to focus on targeting young entrepreneurs. that do not have a lot of liquid wealth today and are building their empires. And these are younger entrepreneurs on the lending side. So lend to them, go give them those super small loans, try to build a relationship, because ultimately they probably don't have a wealth advisor. And the moment you convert over, if you were that banker that believed in them when they were building their business, they almost have a sense of loyalty towards you, and they will most likely sign up with you on the wealth management side. And even though they don't have liquid worth today, the power of time and the power of signing up long-term clients is that over the long term, that client is going to generate a ton of dividends that they're going to want to reinvest in the market, or they may even sell that business and have a lump sum of money that they want to reinvest into their portfolio, which you will then be managing. And that's worth a ton to you as a wealth manager. Now, the opposite end of the spectrum is you can also focus on the older entrepreneurs in your book. And typically older entrepreneurs may already have a wealth advisor, but sometimes, they're really forgotten, or they just don't manage properly. That's what a lot of entrepreneurs, they don't care right now. They're focused 100% on their business. And so, coming to them and saying, hey, listen, John, we've been working together for years. I see you probably have a succession challenge in the next 3 to 4 years. How about we do some pre-succession planning on the wealth management side? Sign up with me. I'll work through that. And as you begin to sell or exit your business, we can talk about how you can reinvest the value of that business into the stock market or into the bond market. So, older entrepreneurs are just as valuable as the young ones, but their payoff is a lot more immediate because they're probably going to exit their businesses in the next few years. Now, I'll give you a very ideal situation. So the ideal situation I see, this is the most common transition, is commercial lenders that are in the healthcare professionals division. It's such an easy transition because they're lending to medical professionals, dentists, doctors, and those medical professionals are one of the highest value clients in wealth management because, again, they have a ton of discretionary income, and they're so busy with their day-to-day practice that they usually outsource their wealth management to an advisor. So wealth advisors just get so excited when they see a potential medical practices prospect. So if you're in the medical practices lending division, you have an automatic advantage because you probably have a book of dentists already, and you probably are targeting dentists and COIs that are serving dentists. So all you're doing, monetize those relationships, convert them over, and bingo, bango, bongo, you're going to sign up probably a few dentists that are worth a ton of money over the long term because, again, it's an annuity business. You sign up $1 million in assets, that $1 million at 1% every single year for the next 40 years is a lot to you as a wealth manager. So it's really important to think about this when you're planning on going into wealth management, monetizing relationships. So what if you wanted to exit into BuySide or private equity? Well, similar to IB, commercial bankers can leverage their sales relationships and credit skills to move into a BuySide role. It is a less common transition. I don't see a lot of it, but I've seen a few. But what usually ends up happening is that a commercial banker is either going to join a private equity firm that is a client already and that they've built a relationship with over several deals, or they may also join a consolidator in the space that they're in. So if they're working in healthcare, then they would join a consolidator of a dental roll-up, like a 123 Dental or Dental Corp, because it makes sense. Again, you're monetizing relationships. So what's really good is that because you have a credit background, a lot of these private equity shops, especially the big ones, they are going to source term sheets on every single deal. So not only are you going to monetize your relationships on the buy side to originate deals for the private equity firm, but you're also going to be running their financing process. So for most mid-sized to large-sized private equity firms, a VP or portfolio manager manages the banking process to get the term sheets for that potential deal. And you can position yourself as that contact for that private equity firm. And the ideal is that you're growing with the private equity firm. So you finance their early deals, they've expanded, they've now raised their second or third fund, and they need a dedicated financing professional to manage that financing process. And bingo, that makes sense for you because it fits perfectly with your commercial lending background. Now, as I mentioned, if you're on the corporate development side, and corporate development essentially means you're a front-facing buy-side representative for a strategic portfolio company. So, I'll give you the example. Dental Corp is a consolidator of dental practices, And so they will go out and buy, 50 dental practices a year. And to find those deals, they have a VP of corporate development or a, associate of corporate development that will go out and either knock on doors direct and buy a company direct, or reach out to other sell side shops and originate those SIMs and eventually submit LOIs on those SIMs. But because you've already been lending to that space, all you're doing is monetizing your relationships and approaching those same people. So, you want to make sure that, if you're going to go into BuySide, leverage the existing networks you already have. So if you were in automotive, work with an automotive consolidator. If you were in medical professionals, work with a dental or, a medical practices consolidator. What if you were in real estate banking? If you're in the real estate banking division and you were doing a ton of, construction financing for developers, it's a perfect fit to join a real estate firm on the origination side and financing end, because you can help them raise financing for future deals and also look and originate new real estate development deals, because you have that mentality and that mindset of analyzing deals already. So it's a natural fit. So you want to match the industry to the company that you're going to be joining on the buy side. Now, a very common transition is private credit, because typically, bankers really love commercial banking, and they hit that ceiling at the director level. They can't earn more within the bank without transitioning to, an executive corporate role, which is, boring. So they typically join private credit groups that are higher paying and are looking at more challenging deals, more unique structurings and loans and exciting deals that, again, it's mental stimulation a lot of the time. And, typically a private credit fund is a private debt fund. It's like a private equity fund. They raise from LP investors. You're a GP, but instead of deploying and buying companies, you're deploying money into private loans to companies. And these companies can be either underperforming and are looking to restructure their business, and so you're lending against assets, or it could be a high growth business like a technology company or a transportation business where, the bank has very set parameters. They need 2 years of debt servicing, or they need, X amount of percentage in loan to value. And if that company doesn't fit it, even though they're highly profitable and successful, they're growing too fast for the bank. And so then a private creditor will come in there and say, hey, listen, in the interim, I'll give the money that you need, but eventually you'll refinance me with one of the more traditional banks. So directors at private lenders are going to earn more. As I mentioned, they'll earn above the $250,000 threshold. And there's no cap on the bonus plan. That's something that's super attractive for private credit. Typically, there is a cap. You're tied to group or, business banking performance at the bank. But here, it's a very plain vanilla formula. If you deploy X amount of dollars at a profitability of Y, I'm going to give you 25% or 10% of the gross margin associated with that revenue that you've brought in for the private credit shop. So there's no cap. So if you were working like a madman, bringing in $1 billion in credit, you could quite literally make a ton of money on the bonusing side, because there's no limit to that. So it's a really good option for commercial bankers that are looking to earn more, are a little bored by the banks and the traditional lending programs and the plain vanilla, AAA deals that they're looking at. And, it's also much more creative. You're taking a client situation and you're trying to structure the deal not only based on amortization or pricing, but, putting in warrants and maybe even buying a piece of the business to get the total return required to match the risk level with the return required for the investors. So that's really exciting and interesting. Now, typically, some of the larger banks will actually have their own private credit shops. So they'll have a leveraged finance team. And so those will be those loans that are 10+% interest only mezzanine loans. And so you can kind of get the same experience on the banking side. But the banks are still naturally conservative. So the sexiest and riskiest deals are still going to go to the private lenders. And B, the compensation, if you're going to go down that path and work really hard to structure these creative loans, the compensation is still limited to traditional banking compensation guidelines, where you're not only comp based on your performance, but the group's performance or the bank's performance in general or the stock price or whatever the case is. So, you're not going to maximize your compensation, even though you may be dealing in the same type of credit. But it may be something that you want to do if the long term is still to stay within the bank, build up, your pension plan and build up your tenure and eventually move into an executive role. Because rotating out of the, more traditional banking into high risk banking is a perfect training ground to understand all the products that the banks can offer, which is really good for, executive leadership promotion. So if that's what you want, then you can still get private credit within the bank. Now, some commercial bankers will try to exit into clients. So if they have a really strong relationship with a client, they've done multiple deals, they over time, again, you're always constantly speaking to these clients for their day-to-day banking needs. So, you start to build a personal relationship. It may feel good to say, one day the client saying, hey, listen, you know what? I really like you. I respect you. I love for you to come onto my team and join me. And so there's typically two areas where you join the client. The first is if you have a CPA background. Some commercial bankers, instead of going to school, straight out of school, they'll go into public auditing or public accounting, and then they'll pivot into commercial banking. So they already have a CPA designation. So then now they've gotten their CPA, they've moved into commercial banking, they've built a relationship with the client, and they can start using that CPA when the client says, hey, why don't you come over and become my controller? So that's a very common exit. Another one is if you don't have your CPA background, you're more of the business BD, marketing, kind of client-facing person for the business, but really the goal is for you to kind of either focus on buying other companies and helping them grow, or just being kind of more the face of the organization for succession planning and leadership development. The challenge with exiting to clients is that, well, realistically, the dynamic in your relationship changes fundamentally. When a client speaks to you and you're on the banking side, they speak to you with a high level of respect because they understand that you have a lot of power. I'm managing your day-to-day funds. I'm managing, your credit lines, and I'm your internal advocate at the bank. So you want to be nice to me. And so sometimes what ends up happening is that clients are going to be really nice to you, but you move over and you join them. And unfortunately, that client now sees you as an employee. So the relationship changes from a banker-client relationship to employer-employee relationship. So the power that you had as a banker is gone. And unfortunately, some entrepreneurs, are very strong-willed. They can be a bit of a tyrant. And so the relationship changes, which becomes fairly unsettling. So I've seen that quite frequently where bankers will exit to a client and, they're buddy-buddy when they're a banker-client, but now they're an employee. And that employer is threatened by their knowledge, threatened by their experience, probably paying them a ton because to move over from a banking job into a small business, you're still going to want your salary to be matched or increased. So they feel like they're paying you a ton, and they feel like you probably are not delivering as much as they initially thought you could deliver. And so there's a ton of pressure, and it is a bit of a pressure pot in there. Now sometimes it works. But you have to manage your expectations. You have to realize that there is going to be a bit of a bump in the road in those early months when you first joined them, because that whole dynamic of you being friends and buddy-buddy is going to change. They are now going to be your boss, and a lot of people forget that that's going to happen. And, the other challenge is that, especially if you've done banking your entire life, especially when you join a mid-market firm, a lot of these leaders wear multiple hats. They're not only managing financing or banking relationships, but they might go out and sell to customers or hire, fire employees. So the day-to-day business management skills, a lot of bankers lack because they've never really have been exposed to that outside of listening to their clients talk about it. So there is a bit of a learning curve there as well in terms of learning how to actually run a business rather than just consult and provide your opinion on a business from the banker's position. So, those are the challenges. But, if you can transition and make it successful, it can also be very highly profitable. And in the recent years, there's been a new trend of search funds. And search funds are essentially one-off, typically one or two investors that are looking to buy a business and then raise funds. So they put an LOI into that business. They then raise the funds after the LOI has been accepted and close on the business and become the sole owner and operator of that company, managing that single investment. So a private equity fund will manage multiple investments in a portfolio. A search fund only raises funds to buy one company and manage that one company. So it's like buying a business, but using other people's money for it. And so, some of the junior commercial bankers, investment bankers, corporate bankers, because they're naturally networking with a lot of investors in their day-to-day roles, they eventually say, you know what, I can do this. I want to go out and buy a business. So instead of exiting to a client and working with a client, you exit to outside and you buy that client, or you look to buy, businesses that are like that client that you've learned from. So, that is another path as well. If you, instead of exiting to an employee relationship, you exit into an ownership relationship. But that also comes with its risks in terms of raising money and the trials and tribulations of that, and also the day-to-day management of a business. Again, if there is a risk in, the learning curve of learning how to run a business, which is very difficult. But in summary, when you look at the broad range of exit options available to bankers, there are a ton of areas where you can see that the skills are very transferable. And these key areas are the things that you should be focusing in on if you know that commercial banking is not your end career. This is really important. And when I first joined commercial banking, I knew that it wasn't my end career. I knew that I always wanted to get into M&A. So I focused 100% on these few areas. And so should you, if that's the plan. And you can kind of obviously pivot based on, the exit area that you want to go into. But the first one, the most important one, I cannot reiterate this enough, is you have to make sure that you invest the time to develop your own direct relationships and COI contacts. Do not become dependent on senior bankers and people that pass off smaller deals to you to underwrite, because then you're not really developing the source of that deal. Typically, that source of that deal is going to be that center of influence, that accountant, that lawyer, that business coach. You want to own that relationship and take them out to lunch to speak to them so that they come to you with the deal flow instead of someone else who then passes it off to you. So you need to start bringing in your own business. It's hard. There's a ton of sales effort required, but if you own your own relationships, you can monetize those relationships in whatever exit career you take on, and that is really, really valuable. That has made me a ton of money because I owned my own COI contacts. The other thing is focus in on certain sectors and develop a deep knowledge of those sectors by dealing with those clients, listening to their day-to-day troubles, and focusing in on developing contacts in that space. Because typically, in most instances, a broad sector like medical, for example, there are medical-focused accountants, medical-focused lawyers. So focus on those COIs and develop those contacts in that sector. So typically, what you should do is you don't really know for certain where you're going to exit when you first join commercial banking, but developing a niche focus on 3 to 5 sectors is very, very valuable because you're going to deal with a ton of those clients in that space, a ton of those COIs in that space, which allows you to develop and monetize those relationships. And it's really easy to if you're a commercial banker because everyone wants to talk to you. You're providing debt. Everyone wants to talk to a banker. It's like, yeah, sure. Yeah, I'm looking at this. I'm buying this. So I want to buy this. Please keep in touch with me. Please let me know when I can borrow this money. So, clients are always very naturally open with bankers and lenders in general. And so leverage that reputation and that brand behind you using the bank to get in front of a ton of people. And once you leave and you move into your own thing, you can take those same relationships and contacts and monetize them to the best of your ability. The third point is don't stay too long. This is such a common mistake. A lot of senior bankers, they regret staying way too long, waiting for things to change, waiting for their passion to come back. As I said, most commercial bankers beyond 7 to 10 years get really bored, burnt out, or they're doing the same thing over and over again, and they really lack the passion to work hard anymore. I've seen a lot of that. When I was in the bank, I would watch the senior guys that were there for 15 years. They knew it cold. There was a constant stream of deal flow from their contacts, but they just became lazy. And that's the challenge with that is that, eventually you become too comfortable to leave. The risk of leaving, the risk of, you having a mortgage and kids, it's the golden handcuffs. It makes you stuck there and you're now dependent on that monthly salary. So you can probably maximize the relationships and skills that you can learn in commercial banking in the first 5 years. After 5 years, I would recommend you should probably start looking for the next one because if you wait too long, you're going to get too comfortable and then you're stuck. And then the last one is build internal networks. And what that means is that COIs are not just independent accountants or lawyers. There could also be, bank-owned wealth managers or estate planners that are worth something to you. So take the opportunity up front to go to internal networking events, training conferences, or, get on those committees where you're cross collaboration committees between commercial banking and wealth management, where all executives are always trying to get the divisions to work together. Get on those committees and start developing relationships with other COI contacts internally. And what I would do at my bank is I would try to talk to any wealth manager that I could, because I knew wealth managers are a primary source of deal flow on the M&A side. So when I left the bank, I maintained those wealth management relationships, and that those have been paying off because I've been getting leads about business owners that want to sell. Because a wealth manager is not going to want to sell a business. They want the assets that come from the sale of that business. So they have an incentive to get the client to sell. And so they'll refer to you and say, hey, listen, use Robert because he's going to be able to help you sell your company. And obviously, I then get your assets to manage, which is profitable for me. So don't turn away from the advantage of using those internal events and networking opportunities, because you can get some pretty good monetary valued relationships from the wealth managers or the small business bankers that are speaking to clients, and you can monetize the relationships in the future. So that's really it. Hopefully you found the video helpful. I know I kind of went in detail into each one, but if you don't really know what sector or exit path you want to take, my best recommendation is you kind of just keep an open mind. You're going to be dealing with a ton of people, as I said, anyways, because you're going to be doing M&A loans, real estate loans, and you're going to come across those agents and brokers and consultants, and you'll kind of over time get to watch and learn and see what you really kind of find interesting. And once you find that opportunity, taking a year or two to pre-plan, continue to invest in relationships and develop that network, and then exiting the bank can be a very profitable avenue for you to do. And it's just going to help you skip a few steps, and it's going to allow you to get, a quick win exiting the bank because you already have relationships in place. Monetizing relationships, I probably said that 50 times in this video, is the greatest benefit that comes from working in commercial banking, especially when you're planning for the exit. So if you found the video helpful, please like and subscribe to the channel. And as well, if you have any other questions related to this topic or any other ideas about commercial banking videos, just comment below and I'd be happy to answer them in the comment section. As well, if you have any clients that are looking to sell their businesses, please contact me on my website or through LinkedIn, and I can obviously help with that as well, as that's my day-to-day now as well. So thank you guys and have a great day. Thank you.